The petrodollar system is not ending because one dramatic headline says it is ending. It is weakening because the habits, trust, and incentives that once made it feel automatic are no longer as automatic as they used to be. That is a much more important statement, and it is also a much more investable statement. Whenever people talk about the petrodollar, they usually speak in one of two bad languages. The first language is nostalgia. It says the old system was natural, permanent, and self-sustaining. The second language is apocalypse. It says the whole thing is about to collapse overnight and drag the dollar down with it. Both languages are too emotional to be useful. What matters in markets is not whether something once looked permanent or whether it now sounds dramatic. What matters is whether the structure is becoming weaker at the margin, because the margin is where trust changes. The margin is where reserve managers rebalance. The margin is where commodity settlement evolves. The margin is where central banks start buying different things. The margin is where old monetary privileges begin to thin before the public fully understands that anything important has changed. That is what I think is happening now. Not the instant death of the dollar, not the end of American power, not the sudden disappearance of oil trade in dollars, a thinning, a gradual weakening of something that for a very long time delivered the United States extraordinary and visible advantages. To understand why that matters, you have to begin with what the petrodollar really was. Most people think it was just an oil arrangement. That is too small. It was an oil arrangement, yes, but it was also a reserve arrangement, a security arrangement, and a trust arrangement after the dollar's break from gold in the early 1970s. The United States needed another source of structural support beneath a fiat currency that was no longer anchored to direct gold convertibility. That support came from power, military power, geopolitical power, and monetary power. The broad bargain was simple enough. Key oil producers sold oil overwhelmingly in dollars. The world needed oil, therefore the world needed dollars. Those dollars were then saved, transacted, and recycled into dollar assets, especially U.S. Treasuries. That recycling kept the machinery humming. It supported demand for the dollar. It supported demand for American debt. It supported lower borrowing costs than many countries could have enjoyed under the same fiscal behavior. And because that structure lasted so long, people stopped treating it as a structure and started treating it as nature. That is always the moment when serious investors should begin paying more attention. Systems only feel natural right before the world relearns that they were built on habits, not on laws of physics. The United States did not merely have a currency. It had a system that made everyone else need its currency. That is a much deeper advantage. And once that advantage is even slightly eroded, the consequences travel much farther than most people expect. Now let us talk about why the old structure is not as secure as it once was. The first reason is geography. The energy world changed. A much larger share of Gulf oil now matters more to Asia than to the United States. When the center of demand changes, the old monetary routines become less sacred. If your biggest and fastest growing buyers are in Asia, then the idea that every barrel must remain attached to the same old currency hierarchy becomes easier to question. Not because the dollar stops working, because alternatives become more thinkable. That is the first thing investors miss. They imagine a monetary shift must begin with a declaration. It usually begins with a conversation. Could we settle a little more in another currency? Could we experiment here? Could we diversify there? Could we reduce some of the automatic dependency that used to feel untouchable? This is how systems weaken, not with a ceremony, with optionality. The second reason is trust. This one matters even more. Reserve systems are built on confidence, not confidence in the abstract. Confidence that the assets you hold will behave like reserves when you need them to behave like reserves. Once countries watched Russian reserves frozen, the issue stopped being theoretical. It no longer mattered whether you approved or disapproved of the reason. The reserve management lesson was obvious. Assets held in someone else's monetary architecture are not purely financial. They are political. And the moment reserve assets become visibly political, reserve managers begin asking a different set of questions. How concentrated should we remain? How much exposure is too much exposure? What asset can we hold that is not another country's liability? That is where gold enters the story. Not as superstition, not as doomsday theater, as a reserve asset that does not sit inside another government, as promise structure. This is one of the reasons central banks around the world have been so persistent in their buying. A lot of ordinary investors still think gold is an old man asset. They think it is what people buy when they are scared, confused, or nostalgic for a monetary world that no longer exists. That is a childish way to look at it at the official sector level. Gold is not nostalgia. It is diversification from concentrated trust. It is what you buy when you no longer want all of your safety inside the same political and monetary framework. That is a very rational choice in a world where deficits are large, sanctions are real, and power rivalry is intensifying. The third reason the old system is thinning is debt. The dollar still sits at the center of the world, but the center is more leveraged than it used to be. That matters. A reserve currency can survive large debt loads longer than other currencies can because it enjoys network effects, habit, and the convenience premium of being the default. But there is a difference between survivability and invulnerability. The United States can run deficits for a very long time. That does not mean the world must admire those deficits forever. At some point, repeated fiscal expansion changes the psychology of the reserve holder. He begins to ask whether his savings are still sitting in the cleanest shirt in the closet or merely in the shirt that remains the least dirty among several dirty alternatives. That is a very different kind of trust. And once trust becomes comparative rather than enthusiastic, gold benefits again. So does reserve diversification more broadly. This is why I say the real story is not whether the dollar is about to disappear. It is whether the old dollar advantage is losing some of its automatic quality. I think the answer is clearly yes. Now, that is where people usually go wrong. They take a correct observation and run it straight into a foolish conclusion. They decide that if the old privilege is weakening, then the right move must be to abandon all us assets, buy only gold, and narrate the collapse of the empire in dramatic language. That is not analysis. That is emotional compensation. I do not think the smartest response is to become anti-American in your portfolio. The United States still has extraordinary corporate power. Its equity markets remain deep and innovative. Its businesses remain among the best in the world. Its capital markets remain far more useful than those of most rivals. The fact that the dollar may lose some of its old hidden subsidy does not erase those truths. It simply means you should stop treating the old arrangement as untouchable. That is different. A mature investor can believe all of the following at once. The dollar remains dominant. The dollar's old monopoly. Like convenience is thinning, gold deserves a strategic place because reserve trust is less concentrated than it used to be. International diversification deserves more respect than domestic. Only investors often give it. Energy and defense matter more in a fractured world, and broad U.S. equities remain powerful long-term holdings even while the monetary advantages beneath them become less automatic. All of those statements can be true at the same time. That is adulthood in macro. The childish investor wants a slogan. The adult investor wants a map. The map right now says something like this. The old center is still the center, but it is no longer the only place where serious capital wants to feel safe. That shift matters. It matters for central banks. It matters for sovereign wealth. It matters for reserve composition. It matters for commodities. And eventually it matters for the average saver, even if he never hears the phrase petrodollar once in his life. He feels it through purchasing power. He feels it through inflation sensitivity. He feels it through the changing relationship between hard assets and paper assets. He feels it through what his currency can buy and what his savings truly represent. That is why I do not dismiss this story. I just refuse to tell it stupidly. Now let us talk about the practical portfolio implications, because that is what most people actually need. The first is gold. I do not think of gold as a productive investment in the way I think of a business. A business can compound. A business can reinvest. A business can raise prices. A business can throw off cash. Gold does none of that. Gold just sits there. That is both its weakness and its brilliance. Its weakness is that it needs no imagination to be dead money in periods when trust is strong and productive assets are thriving. Its brilliance is that it needs no imagination to remain itself in periods when trust weakens and reserve managers start looking for something outside the liability structure of another state. That is why I do not like calling gold an investment in the same emotional register as a great operating company. I prefer to think of it as a monetary hedge and a reserve-style asset. If trust in the dollar system remains high, gold may disappoint. If trust continues thinning at the margin, gold remains one of the cleanest answers. The second implication is international diversification. Again, not because foreign automatically means better. It does not, but because the old habit of putting almost all serious capital exposure through the U.S. lens is less obviously sufficient than it used to be. A broad excess allocation, a developed market sleeve, an emerging market sleeve, these are not acts of rebellion, they are acts of calibration. If trade settlement becomes more multipolar, if local currency arrangements expand, if reserve diversification continues, then the rest of the world matters more than a purely U.S. centric investor may be used to admitting this does not mean that every foreign market becomes attractive at once. It means the world becomes less one pole than it used to be, and your portfolio should at least be aware of that. The third implication is energy. People hear this and immediately want to turn it into a narrow oil call, I think too narrowly there. The broader point is energy security in a world where the old monetary energy security arrangement is less rigid, reliable domestic energy production and infrastructure matter more, not because every oil stock is a buy, because countries pay for resilience. And when resilience becomes strategic, energy assets and energy infrastructure can deserve more weight than they did during the years when people assumed globalization would remain smooth and dollar settlement would remain unquestioned. The fourth implication is defense. This one makes people uncomfortable, which usually means it should be examined rather than moralized away if the world is more fractured, more regionally tense, and more concerned with protecting choke points, shipping routes, and supply chains, then defense spending remains politically durable. Again, not because that is beautiful, because that is what systems do when they feel less secure. The fifth implication is the broad U.S. equity market. This is the one I want to be very careful with because it is easy to say something irresponsible here. Broadest equities remain one of the finest long-term ownership vehicles in the world. The United States still houses extraordinary businesses. It still has immense entrepreneurial power. It still dominates in many parts of technology, software, capital markets, and global corporate quality. You do not need to abandon that simply because the old petrodollar privilege is thinning. In fact, that would often be the wrong move. The wiser move is to continue owning the United States while also admitting the monetary architecture supporting it is less unquestioned than it once was. That is a more balanced and much more useful posture. One of the great errors investors make is treating every structural shift as a command to do one thing all at once. Sell all dollars, buy all gold, go all international, hide in energy, bet everything on defense. That is how amateurs behave. Professionals calibrate. They increase some weights, they build some hedges, they widen the map. They stop trusting a formerly absolute assumption quite so completely. They do not wait for the world to end. They act when the old certainty stops deserving full confidence. That is what I think this moment is asking of serious investors, not a revolution, a recalibration. And now I want to return to the phrase at the beginning. The petrodollar system is coming to an end number. That is not the sentence I would use. The better sentence is this. The old petrodollar advantage is losing some of its unquestioned quality. That sentence is less exciting. It is also much more profitable because once you frame it that way, you stop waiting for an all or nothing event. You start watching the margin, more gold buying, more reserve diversification, more local currency trade, more strategic independence among producers, more pressure on automatic dollar recycling, more awareness that a reserve asset inside another country. Political system is not the same thing as neutral money. Those are the signs that matter. They are not loud enough for the public. They are loud enough for capital, and capital always moves before the story becomes simple enough for everyone else to repeat it confidently. That is why this matters. Not because you need to become a currency theorist, because the hidden advantages embedded in a monetary system shape everything else. They shape borrowing, they shape inflation, they shape asset demand, they shape how easily one country can finance itself relative to others. They shape how strong paper promises feel relative to hard assets. And when those hidden advantages start thinning, even slightly, the portfolio response begins long before the average citizen notices the world has changed. I would rather you notice early, not so you become dramatic, so you become prepared. That is the job, not to predict collapse, to recognize erosion. Erosion is enough. It is enough to justify gold as a strategic hedge, enough to justify more respect for international diversification, enough to justify serious attention to energy and defense, enough to stop treating the old dollar-centered world as untouchable, enough to matter. And in investing, enough to matter is often all the edge you ever get.